Market outlook. This is my regular weekly commentary on the market as well as the software itself. And this time, actually, I wanted to start with what was happening in market, especially when we have September coming up very soon. So, how the overall stock market is performing, its behavior and outlook. Let's get over with this disclaimer first of all. So the material presented here is for educational learning purposes only and should not be taken as purchase or sell recommendations. Trading, investing in stocks and derivatives, especially futures, options, etc., is risky and could result in a substantial loss of invested capital. I'm not a registered financial advisor with FINRA or SEC. For any financial advice, please consult a registered financial advisor. And what it means that please do not discuss or disclose your personal financial condition or your personal trade that you take. Do not expect me to advise you on those specifically, and a registered financial advisor will be in a better position to assess your financial condition and give you personal financial advice on those. So thank you very much for joining me over the weekend. And we have 14 participants, 5 more hopefully will be joining as we go along. So the big picture of the stock market itself, I am bullish. And for those of you who have been following me for several years, I have been bullish ever since the bull market started. Some people said it started after 2009 crisis, but actually we say that it started around 2013 when it initially hit a new all-time high at that time. And since then, it never looked back. The market remains remarkably resilient with whatever is going on geopolitically, economically, and other forces which are playing out. And then we also look forward towards a very strong seasonal window, which begins in 2 months from now, late October, maybe this time a bit late after midterm election in early November. But we need to be cautious short term. There are quite a few headwinds which we are facing right now. For example, rising treasury yields and the semiconductor groups as a whole is digesting a big run which it has had over a period of last 1 to 2 years, especially last 1 year. September is being the weakest month ahead for from all the 12 months in the calendar year, and we will take a detailed look at the seasonality patterns. The midterm election is also around the corners, first week of November, and normally the period before it historically has been a choppy period, a roller coaster ride, because market hits uncertainty and it's want certain policy, certain future outlooks. Otherwise, traders gets confused, and obviously, everyone cares about his or her money, and they would like to play safe during those kind of periods. All right. So moving on, an important event that has happened recently is about the bond market. And right now, I think that that's the signal that matters most. What is that? The bond market 10-year treasury yield is 4.75%. And historically, whenever it reaches an all-time high, close to 5%, and whenever it gets close to 5% and beyond that, which is a 20-year high, it would likely spook stocks. And on the other hand, just on last Wednesday, the Treasury announced that they are going to buy back the 10-year Treasury yield and the 30-year Treasury, sorry, 10-year Treasury bonds and 30-year bonds in a move to trying to bring the yield down. But that move lasted only for a day. And the next day, the bond prices, the yield again, they started rising up back to the same point. And rising August October yields have coincided with corrections in past. And why it happens? Because when you have high yields on 10-year, 20 and 30 years of treasury bonds, those are generally taken as safe investment vehicles compared to stocks. because at the end of their maturity period, you will get the same principal back along with the interest along the way. So obviously, the people who are investing in stocks, they are demanding a higher rate of return than this rate of return. Because in stocks, there is no guarantee. Stock can theoretically go back to zero and you can incur losses along the way. So that's why the stocks return should be much higher than this in order to make up for that additional risk. And as you know, we don't deal in the bonds at all, but the where the bond market is heading towards, especially this interest rates and the 10-year treasury yield, that is something that can negatively impact if it goes beyond 5%. Because most of the people say why we should take extra risk, and they will pull out money from stocks and put into the bonds. And this is where the stock market will have a negative impact going forward. Not only this, we have a Fed meeting as well. On one hand, Treasury wants to decrease their Treasury yields. That's why they are trying to buy back, and they have introduced a plan which will uh, starting from September 9 and somewhere in October. On the other hand, Fed is most likely to keep hiking its interest rates, basic interest rates. Why? Because they want inflation to be on a lower side. They do not want the inflation to pick up, which unfortunately, because of the geopolitical tensions, rising cost, oil prices, is heading up or inching up. But Fed has made it clear that inflation is its top priority. So on one hand, the Fed would like to hike the interest rates, although President does not want it, but the market forces can push Fed towards hiking interest rates going forward. On the other hand, the Treasury is trying to push the yields down. And honestly, Treasury does not have much control in this big puzzle. They do not have much control, and they normally their efforts are subsided by the Fed interest hikes, if any. So we are going to see a very interesting period. But these different kind of forces of opposite direction, they can obviously derail a rally, market rally, from its peaks. Okay. So moving on, let's analyze and see how the markets are doing right now. And we'll take a quick look on those before we. So if we go to this is our software where we have the weekly commentary, latest weekly commentary, and our analysis. If we just pull up the latest weekly commentary, which is right here, and view this PDF, which is already open here. So the performance of latest market in major indices. Friday was positive, surprisingly, although it was an option expiration day. But markets have already come down prior to the Friday, and that led all the major indices ended red for the week. For example, S&P 500 was down minus 1.4%, while Nasdaq was down approximately 2%. And the tech-heavy Nasdaq 100 was down 2.4%. Dow Jones Industrial also down by 0.85%, and so were the small stocks index, this is Russell 2000 minus 1.68%. But the positive side is that on the year-to-date basis, at the month-to-date basis, in the last 1 year, 52 weeks, they have performed very well. Russell, for example, has given 33% rise, and Nasdaq 26%, mostly because of semiconductors, which have been very hot, and S&P 500 20%. While the overall average market rate, annual growth rate is around return is 8 to 9%. But as the treasury yields increases beyond 4.75% or 5%, and on the average we are getting a 8 to 9% from S&P 500, then obviously the gap will be reduced, and that will negatively impact the stocks going forward. Very quickly, the different 11 sectors, and only 3 of those sectors were positive last week. And those were not in aggressive areas. The aggressive areas of the market are technology, which was down for the week minus 3.5%. Discretionary and consumer cyclical, minus 0.15%, and communication minus 1.37%, internet and Google and others. On the other hand, neutral sectors or somewhere in the towards leaning towards the aggressive is industrial. It was also down minus 3.36%. Industrial of the big guys like GE, DuPont, Boeing, airlines, these companies, manufacturing, they lie in this area. The defense and the energy and the basic materials, they were, besides the third one, which was healthcare, that these three were in positive range for the last week. Energy and basic materials are mostly neutral sectors. They are neither very much aggressive nor very much defensive in nature, and they are more actually prone to the geopolitical events, tensions, currencies, and policies rather than the aggressive appetite of the investors who are investing in stock markets. But the important distinction is that the defensive groups, which are utilities, real estate, and staples, consumer defensive, they were all negative. So what it means that the capital was being rotated not from the aggressive area, not to the defensive area. Rather, it was flowing into some in the middle ground, like materials and industrial and healthcare. So, is the net capital coming out of the stock market? I don't think so. The net capital is coming out of these aggressive area and going towards some neutral areas, which are actually performing very well for the time being. So, this is something that needs to be taken into account before making any immediate future decisions. All right. One specific note about semiconductors. Now, why semiconductors are very important? Because bull markets are always driven by aggressive areas like technology. And the biggest component of technology are semiconductors. In fact, semiconductors account for 18% of S&P 500 capital values, market capital of all companies combined together in S&P 500, and 29% of tech-heavy Nasdaq 100. So if the semiconductors are in a bull run, that will drive both of S&P 500 and Nasdaq. Obviously, along with some other sectors as well, but these are the major stakeholders. But if the semiconductors and the overall aggressive areas are not doing very well, then these two major indices will continue to struggle. They cannot have a bullish run just like they had in the recent past because of the semiconductors. So from the period March to June, semiconductors have more than doubled, starting from 31st of March, 100%, more than 100% of value. But starting from the mid-June, last 2 months, actually they are in a bear market territory. Anything above 20% is known as a bear market. So for the semiconductor, it's gone into the bear market to 20%. If we just look at these figures. But we need to expand our perspective. The perspective is that they have already had a very good run just prior to this period from March to June and during the last 1 year as well. So obviously it is natural to give back some of it. So we cannot just say, hey, is it market is terrible and semiconductors are falling apart and it's just 20% loss. No, that's not true. In reality, it was due. Because you cannot have 100% return in, let's say, 4 months, and then another 100% or 50% return in another 4 months, and things go on. That's not the way it happens. Every time when it happens, if you have this spectacular run, then market has to, or those hot areas have to give back some of their gains. So and that's natural, and that is good for them in the long run. So their fundamentals, what I'm saying is, are still strong, but the valuations have gone too far and too aggressive in the upper direction, and they are now catching up. They're going back to the moving averages, and they will start forming bases. So near term they look weak, but long term again they are poised to lead again. There's nothing fundamentally wrong with the semiconductor group as a whole. So at this point, let's say we take a look at some charts. and seasonality. So see what happens on the chart basis. So for example, this is S&P 500. On your left, you see S&P 500 is coming down from the top. And on the right, both are S&P 500. This is our daily chart left, right is the weekly chart. And you see, we are still, as far as S&P 500 is concerned, we are still at a very high level, very close to the highest level. Reason being, when the semiconductors are coming down, healthcare, energy, and industrials have picked up, and basic materials. And those are coming up. So, for example, let's take a look at technology sector, tech sector. So this is what tech sector is doing. Start of the April, it came out of a sharp pullback due to the Iran war, and then it is moving in this direction. For those of you who are new, this is our TR indicator. In the bullish side, it has three stages, and the downward side has three stages, bearish side. This is the first stage, and whenever the green zone is started, we say this has picked momentum. This is the second, and this is the third. And then you can expect a larger move ahead in this direction. But when you start facing this kind of things, means either it's a consolidation, temporary pause, or beginning of a bigger move downwards. So semiconductor, this is tech sector as a whole. But if you just take a look at the semiconductors, only on the semi, this is indices. So let's see, we take a look at semiconductors and put semiconductors ETF SOX. Here you see a different picture. It had a big run starting from the same period, March, April. It was leading the market, leading the tech sector. But as soon as it is cooled down, started coming down, and it has given back more than 50% of its gain from this period. But this is perfectly normal. If you run a Fibonacci, probably it has given 61% of the gain it returned in this short period of time. But on a weekly basis, if you see it, it is still not looking that bad. Now, is it a good time to enter in semi? Now, when we talk about semiconductors, we are saying big companies like Nvidia, AMD, Broadcom, ANET, all memory devices like storage devices like SanDisk and MU, companies like Qualcomm, companies like those. But what exactly is the entry point for semiconductors? It's something like this. That this is on it. This is a TR indicator for the trading view. Here we have a small tight range, and this is breakout, and this was normally is the point to enter rather than chasing it as a high side, because at high it's most likely to come back, give back its gains, catch up with the moving averages, do something like this, and then start moving the same direction again. That is why it's time to be skeptical about whether it's go back immediately or will it come back to the further down. And for that, we will also take a look at the seasonality of these semiconductors and the aggressive areas as well. Similarly, we can take a look at all other major sectors. This was a tech sector and semiconductors. What about discretionary? Discretionary is been a very in a choppy period. And if I just switch, I have a favorite ratio kind of thing. So let's see how in relation to this S&P 500, tech sector was performing. So again, same story. Tech sector was performing very well starting from March to June, but since then it has been struggling. And that's why it's not a good time to enter into tech sectors at this point of time. Check it out with the semiconductors. Semiconductors in the same shape because tech sector is led by some two major groups, semiconductors and software. And software, by the way, are doing better right now. In a prior period, like 3 or 4 months ago, they were not doing much better. But if you take a look at, for example, healthcare or energy, healthcare is this one. This is healthcare recently. It is still a long-term downward trend, but recently it has picked up starting from again mid of June. It consolidated then again at its recent highs. Now, healthcare is not high growth area like tech sector. That's why it's kind of a defensive area. But the capital is being, we can very easily see that capital is being rotated from aggressive area to areas like healthcare. And then we can find some good stocks moving in this sector. What about materials, which is XLB? Materials include gold, copper, and so very recently, for last 1 week and for last few days from here, gold it has come. Now, this is a ratio. Performance of materials compared to relative to S&P 500. It means that while it is going up, it means that S&P may be going up, but not with the same intensity and momentum as this particular sector is moving. And this is beating S&P 500 right now. So that's how we take a look at the relative performances of these sectors and the groups within them. Now, going back to our presentation, we have another problem lying ahead, which is the September problem. And what do we mean by September problem? The September rises only 45% of the time during the last 76 years, dating back to 1950. Now, this has been a research done by Tom Bowley of Earning Beat. Just let me put this on record. And I really like the work he has done. So, according to his statistics, September has risen only 45% of the times. Or 55% of the time is the only month in 12 calendar months which has a negative average return as far as history goes. And the NASDAQ has fallen 62% of time. So NASDAQ is even worse than S&P 500. Why? Because NASDAQ is being driven by growth stocks, by tech stocks and semiconductors mostly. And for them, September has been traditionally a weaker month. And 8 out of 9 last times since year 2000, when there were move of S&P move of 4% plus in the month of September, 8 out of 9 times they were on the downsides, means minus 4% or more. And only once there was a plus 4% or higher for the last 26 years. Now we have good news as well that the strongest seasonal stretch begins in just after October, late October, and S&P has risen in 67 of the last 76 years from late October to mid-January, approximately 87% of time. So near-term caution can give way to a powerful year-end runway. Now, why it happens? A lot of factors. Maybe the rebalancing of the portfolios. Maybe every 2 years we have elections in US, midterm, and then the final election in November. Maybe the earning season gets over by September for the second half, second quarter. Combination of these things have made this period interesting as well as very, I would say, uh, not very good in terms of return. Does not mean that it is guaranteed, does not mean that it will always happen. That's not the case. But these are the probabilities. The 62% of the time Nasdaq has come down during this period. So if we go to our software, for example, and we check the seasonality. So let's say we check the seasonality of S&P 500 for last maybe 15 years. And we have a feature here, seasonality page, which is a very good feature. And those of you who have access to the software, please take a look at the features. And like we have monthly top performers, which can give you a list of the top performers during the month of September, going back to the last 20 years. Anyway, for the last 15 years, from 2011 to 2025, Vision is the weakest month when it comes to return, minus 0.9%. Only month which has a negative return for S&P 500. And S&P was, for the last 15 years, was 53% up. Overall, from the 1950, it was 45% up, as we just saw in the last slide. But September is this period, August, September, and October, is a struggling period for S&P 500. But for growth stocks like NASDAQ, so if we check Triple Q, which is an ETF for NASDAQ 100 stocks, and check their performance, this ETF performance last September minus 0.9%. Oh, this is still SP5, sorry. Let me update it for QQQ, and then now it's the QQQ. -1%, 0.8% for August. October then is starts getting better towards the end of the October. Well, the same story repeated here. If you which is the worst month for Nasdaq? September. And which is the best one? July. Okay. Now we move on further drill down to tech sector and we see, okay, tech sector, which is the biggest component of Nasdaq and S&P 500 both, and you will see the same pattern. September has been the weakest month, -1% return, and it's just 53. It's still QQQ, I'm sorry. I have to change it to XLK and XLK, not XLKI. It's not taking this thing. Here we go. September again for the tax sector. XLK is -0.8%, 60,
Okay, sir.
and it.
Yes, yes.
Please put your phone on mute. 0.8%. Let me mute all the participants.
Nairobi.
Okay. And the worst one again for the tech sector is -0.75% average return for the last 15 years here has been September. Now it's not like that September is the worst one for everything. There are some groups which move better than others, like health sector, like materials. So if we, for example, check out for materials and let's say narrow down the period to last 10 years. Materials are also in general negative this period. Honestly, this year could be different anyway. What about some defensive sector? What about financials or some defensive sector like utilities? Let's try utilities. It's still negative. So overall market is negative for the September, even though. But October is a much better month, just like July, for utility sector, based on the data from the last 10 years. So the point here was that September itself and October including till the mid of October, this year is special because we have the midterm elections early in November. So we could expect a choppy period going ahead. And we should be ready for that rather than fighting the market going, and especially while we are having this problem, the bond market issue, the rising yield, especially when this is happening. Then we should be very careful while taking new position, especially in tech stock. I would say a better strategy would be to avoid tech stocks in general, especially semiconductors, during the next 2 months. Now, the counter argument is that if they come down, isn't it a better place to buy them at a lower price? Yes, it is. I agree. But what is what do you think when we take a look here that what exactly is the bottom? Why not this let's say this tech sector or semiconductor ETF? Why not it can break this support? Why cannot it break this thing? Why cannot it move down to this 200 line and go to this breakout level in the past right here? Very easily it can do. It's just a couple of 3 or 4% down there and it will reach here much quicker than you and I can think of. A market has the capacity to do this. So it's better to let it consolidate like this and then at a lower level form the base, then start a good period and start this green zone, and then you start making entries at that point. Just like over here in April, just like last year in June, these are the time to go long and strive for better move. Look at what it did last year, September as well. It for the 3 or 4 weeks, it came down. This is also this is September. This was September, and this was November. So it can do these things. And this is again semiconductor stock, and we need to be careful of that. We should not be just blind, and we should not just trust, okay, this is seasonality, we should not go long, any long. No, that's not the point. The point is we should be careful of the headwinds which we are facing, and only choose those stocks which are at a good buy point and which are leading in their respective areas. That's the point here. So moving on, what are now the next question come, which are the good areas? Okay. So let's see, we go back to the software again. And in investment idea page, we have a tab here, industry groups. And this tells us the medium member performance in the stock above $10, which have their breadth, the percentage of members of their 20 period EMA, they are in a bullish trend. In other words, it is telling me right now that which of these groups are the best groups for the time being. So surprisingly, travel and tourism, with seven stocks in this group, are there, and then followed by energy, exploration and production, then container and packaging, railroad, marine transportation, then real estate services, and gold mining. Now, if I for the last 1 month, I sorted out that the gold mining has been the top one for the last top group with 35 stocks in it for the last 1 month. Then followed by non-ferrous metals. Then general mining. The non-ferrous metals means copper, silver, platinum. Then followed by software group, again travel and tourism, medical equipment. Now the healthcare comes, medical equipment, medical supplies, then some entertainment companies, and then biotechs, healthcare again, biotechs, followed by computer hardware and services. Then come others like, but you won't find uh, many tech areas here, like semiconductor. Semiconductor is somewhere down there because they have a negative return for the last 1 month. So maybe if I sort it in the reverse order, which was the worst groups during the last 1 month, trucking, tobacco, multi-utilities, airlines not doing well. Semiconductors is right here with a minus 3% return of average for the last 1 month. But for the last 1 year, look at their return, 107%. So which was the best group? Semiconductors for last 1 year, 107%. But during the last 1 month, they have come down by 3%. And last 3 months, minus 15%. So maybe this is not the right time. It's just they are just cooling off, giving back some of gains, as I described earlier. And maybe it's time to look into areas like gold mining, non-ferrous materials, biotech, and other areas instead of just focusing on semiconductors. So this is what a mistake which most of the people do every day. They think that if the micron has gone up, it will continue to go up. If the Broadcom is doing wonderful, then it will continue to do that. No, market is maybe changing positions, and for some time, other areas will pick up which were neglected in favor of semiconductors in recent past. So that's the point here. So which are those areas? As we just explored using that industry group feature of investment idea list, these areas: gold miners, base metals, biotech, energy, materials, travel and tourism, restaurants, surprise, and railroads. So the point here is the capital is rotating within the market, not exiting it. It's not going, but the bond market situation can change it going forward. Capital may start exiting the stocks and going into the bonds if the yields keep on rising, and that will negatively impact every branch of the stock group, including these groups as well. Right now, value is leading. These most of these stocks here are in the values. They are not very high growth, high octane, or aggressive stocks. The market held up without the magnificent seven, the big seven companies like Amazon, Netflix, Microsoft, Apple, Nvidia. They're all kind of consolidating or coming down or struggling, but all these areas are picking up. Cyclicals stirring, I mean discretionary, like travel and tourism are cyclical, this area. A possible broadening into Q4 leadership. And if they continue on like this, then maybe in the quarter four, You can find more winners in the travel and tourism and other cyclical areas. No rotation into defensive. The classic topping signal is absent. Now, what it means that before any major correction of the bear market, normally the capital flows from the aggressive area into the defensive area, staple utilities and real estate. But this time it is not happening. The capital is going to these areas. So the classic topping signal is absent. So that's why it's a mixed bag. We cannot say that it will come down because we don't know. There are certain unknowns, like the bond market situation, like the interest rate situation, like the rising yield situation on treasury bonds. But as of right now, I don't see a big jump down to the areas of or the big drop in the market correction right away. No, because defensives are still out of favor. As we saw that defensive are still not being preferred by investors. Okay, so are we setting up for a correction? It's possible, but it could be a normal one, not a broken bull, means 20% or more. So for example, from the recent levels of S&P 500, even if it comes down to 7,000, it will be just a 10% drop. If it just retests the breakout, normal behavior, and a weekly negative divergence has formed, I will explain it on the graph. So the 20% bear market looks unlikely. This is what I was saying, that up 20% or more looks unlikely. As long as we hold the 20 and day moving average and 7610 level with momentum, little to worry about. But chances are there that it can eventually come down to even 7,000 level. Let's go back to our chart and see what chart is telling us about S&P 500. So this is the chart for S&P 500. 1 second. Right now we are at 7674 as you see it here, right here. And the level we should be careful about is this breakout at 7,000 levels. Market broke out from here, this level, this dotted line right here on the right, this here. So as long as we are here, if it does not undercut this thing, then we are fine. It's just a normal pullback. But if the market takes a big shift downward, break this language and come down to here, this level, then the trouble brewing, and it can touch these levels and even below this thing. The negative diversion was this thing, that as the market was going up, now how the PPO is coming down. PPO is another form of MACD, popular MACD. When it has this kind of action, the weekly is yet to pick up. Generally, it means the market will go below and find support at maybe at a moving average. So far, what market does whenever it comes down this 20-day period, which is blue line on the daily chart, it finds support, and just as it did on Thursday, find support and move on to. But it could be a temporary phase, because what it will do, if the push downward is stronger, then it will break this level and go to the next support, which is this one, and then obviously the next one if the move downward is too aggressive and too fast in nature, which can happen because of the pending Fed decision as well as the Treasury bond yield conditions. All right, so this is what we are looking for. Bottom line is that if you are a long-term investor, then stay the course. Ride out September turbulence. There will be turbulence. It could be temporary. Market can further come down, as we all mentioned, but it's not the time to be aggressive in aggressive areas. It could be a time to explore neutral areas or somewhere defensive, maybe like healthcare, energy, and materials. On those areas which we mentioned earlier, that those which the software has mentioned, that they are in nature right here, these groups. So keep an eye on these groups. If the groups starts shifting and the aggressive groups come forward on any given day, and these groups start coming down, then obviously the mining and then again another rotation is going to happen. And in reality, if you want the market to move to new highs, then you need aggressive groups like software and the semiconductors and the tech sectors. Those on at the top of this list, rather than these materials. And the material means more people are investing in gold, coppers, and silver kind of areas. All right, moving. So if you are a long-term investor, you are there for months and years. You need not to worry about that. You need to be in good stocks, long-term stocks, and you can forget about it because this is going to be most likely a short-term action. The secular bull market is still intact. The quarter four is starting from late October, as I mentioned, into January has historically been a very rewarding period. We have done Thanksgiving, we have done holiday season, Christmas, and the New Year. And they kind of a euphoria among the people to invest and save and in risk on, I would say, method strategy. They tend to adopt those kind of methods rather than taking a defensive position. Short-term traders, people who are just for the swing trades. Now, the swing trades, they normally struggle in this because you don't know what is happening today, which is rising today. Tomorrow it will come down, and it is dodgy situation. It's not something like a very bullish situation where the swing trades will work out. So heightened caution for the next 4 to 6 weeks. Raise cash. Now cash is a position. Raise cash so you can protect your capital if key price supports break, as we discussed and we saw the S&P 500 chart. Watch the yield and the semiconductors. Let price action, not headlines, lead. Headlines are normally made to divert the market and investor into a certain direction. Let the price action of these charts lead you rather than following the headlines on day-to-day basis on CNBC. So that's pretty much it. I can open up, or you have any questions? I can answer the questions as well. One second. There's a message that please explain the last two column, Brett and okay, he was asking about this thing, Brett and WRT. There's no WRT here. The breadth is, if you scroll down here, the percentage of member stocks trading above their 20-day moving averages. So if you know that the above 20-day moving averages, uh, a stock is bullish in nature, moving upwards. So if 91% or 90% or 70 or 100% of stocks, we have, for example, 35 stocks in gold mining area, go group. If they 90% of those stocks are above their 20%, that means that this group itself is trending higher. Gold mining sector. What is the one of the ETF is GDX. Take a look here at GDX. So while the market is coming down, what GDX doing? GDX doing this, right? Right at the top of the chart. Bullish. Is it a good time? I don't know. I would prefer GDX to be at this point or this point, not here. Because as GDX is going up and up and up, the profit taking will kick in. And eventually, there is a room to grow? Yes. Because on the weekly chart, I still see some room. But your stop losses will be too wide. And that will put you in a risky situation if you start chasing things. Better point is to catch the earlier moves when the strong momentum it picks up. WRT, probably talking about weighted rank rating. WRT, I don't know from where you picked up, it's not here on this table. For any given stock, if the question was what is WRT? Weighted rank rating for any stock, for example, if you want to analyze which is the best stock in GDX, FCX, it's probably one of the best gold miners. Freeport McMoran, and the WRPCT is this in 91. Now, what it is telling you, the is price action, the way it is increasing with the rate and the 1 year return is better than 91% of the stock in our universe of 5,700 stocks. And that's why it enjoys a very good conviction score of 6.5 out of 10. Now, if I have a few questions. There were some questions asked that how do we, what are the stop losses? We scroll down here, this is the recent prices. These are the suggested stop losses if you enter at this level. If you enter, this is minus 7% stop loss level, minus 10. Before entry, you should take a look at where are you going to be your stop loss, minus 10, 12, or 15%. While if you set your target level, this should be your price level. If you take a look at the FCX, 1 year performance 83.75%. 1 year performance of S&P 500 is just 20%, and material sector itself is 20%. So it's a leader in its own sector, in its own group. That's how it is. It's a leader in its own group, which is a non-ferrous metal group, and it's a leader against S&P 500, and the group itself is a leader. But the material sector overall is a lagger. Non-ferrous metal is a leading group, but it's part of the overall material sector, which has picked up recently. But for the last 1 year, it has not beaten, in other words, S&P 500 is at par. Okay. Samal Malik has a question. Please shed some light on long-term stocks. Nvidia and Vijay, when their earning is coming in tech, as you said, will still. Yes, they are expected to underperform. Reason being is we are in a weak period. Number one, seasonally, for the tech sector and for these stock, Nvidia and Broadcom, if the earning is coming and even if they beat their earning, you cannot expect Nvidia to do something like this. It might rise only if the market is falling to give up and roll over. But under those conditions, when it beats earnings, it beats revenue estimate. Let's take a look at Nvidia. The question was on Nvidia and Broadcom. Now, this is Nvidia. You see, it has started rolling it down. Over now, what do you think of the chances that Nvidia go and jump from here? Nvidia is a 5 trillion company. When the market is in a kind of a bearish period, you think that Nvidia can go and move 20%? 20% means another $1 trillion worth of capital flowing into Nvidia, which is difficult, especially during when the market is not in a bullish phase. So that's why at max probably Nvidia can touch its price if the future guidance is very good, but it's not in a bullish phase. Two, I would say that it can just go and because you should always look where Nvidia, if you enter here, what is your going to be a stop loss? Your stop loss is going to be ideally here. So if you read my weekly commentary, I mentioned that better price will be to if let Nvidia come down close to this 200 level with a stop loss below this level. Then you have strong chances that Nvidia will go back and touch these highs again. Same case with Broadcom. Broadcom has come down very abruptly and sharply. So that is why Broadcom is just pulling back, moving up, but it is still in a downward trend for the time being. Long term, you're going to be okay. Both of these stocks have very good long-term history. Even if they struggle for a while, maybe for a couple of months, maybe a couple, but eventually they will come out because the company have good solid business. Yes, I do. I have stop losses for long-term stock as well. And the way I do, for example, this is Broadcom. Now it depends upon where is my entry. If my entry was, for example, from here, I still have this much of profit cushion. And my stop loss was here. As we move up, we bring the stop loss to the break-even level. So even if it comes down, I end up in losing nothing on this trade. But obviously, we want to make some money as well as we go along. So if when it seems extended, then we take out a portion of it and then leave the rest to run. That's how we manage the long-term stock. Now, the long-term stock, how much should be your stop loss? That's the question. And generally, the long-term stocks you can even go as long as high as up to 12 or 50% of stock, 15% of stop loss, something like this level, 12, 15. But if for all other cases, this should be your range, 7 to 10%. Because there are only a very few long-term stocks. If you go to my weekly commentary, only 5 or 6 are there in the long terms. Some of them qualify for the long term as well, like gold, like MU, but they have sharp pullbacks along the way. That's why I have not put up those on the long term radar. But everyone is different. Some people can treat Eli Lilly is a long term stock, in my opinion, these days. It qualifies as well, but it's extended. Gold is a long term stock. I agree. SAP, for example, we picked up SAP for some time ago. It's not a long-term stock, including Microsoft. Take a look at SAP, for example. Now, SAP is a completely different picture. We picked it up something around 100 this level when this green zone is started. And in a few weeks, I would say more than a month, right now, how much is SAP? Oh, no, this is something different. We should look at SAP stock. This one here is 219. And we picked up at some around 150 level when it started this thing. When it jumped, this jump, we made a bold decision. Okay, we want a short stop loss here. Right now it's extended, for example. If you enter here, can it go? Yes, it can go. There are always chances. Point is, are you ready to take this much of stop loss, which is 217 minus 180, maybe 20% or higher? No. I will wait for something like this action again, that it come down to this level or this level, and they make a tight stop loss. Okay. Anything else? Any more further question? I can open up the mics if you want, but I don't think that it's required. You can drop your questions over here in the chat box. Take a run to DIRAM. What is DIRSM? DIRAM? I think you're asking for DIRAM. DRAM. Asking for DRAM, right? Okay. Now, is DRAM, what is DRAM? DRAM is a fund which is, what happens now, it's splitting you right here. Okay. DRAM is a fund, and we went long and we took this trade back in, I think, May or April. When it was introduced, we saw this trend. It was too new. And along with the tech sector, now remember what the tech sector was doing? Tech sector was doing the same thing. I showed the tech sector, which is XLK. Same pattern. So tech sector was on our side. Semiconductors or memory storage devices were on our side. That's why we took a position here on the DRAM in the previous chart right here when it started. But right now, tech sectors are not working. We are heading towards a weak period, September, October. Better to stay put and use your cash. Now, all tech stocks, whether it's TSM, whether it's CRM is also tech stock, it's software. They are, they fall into this same category. Don't follow them unless the tech sector founds a footing, unless the tech sector gives you something like this kind of thing. Strong TR indicator, persisted above these indicators and this rising, this green. Unless you find yourself in this position, don't go into the tech sector stocks at the moment. All right? Whether it's TSM, whether it's CRM, whether it's Broadcom, whether it's DRAM, whether it's whatever. But I can very quickly take a look at some other like CRM and others. Software could be an exception like SAP. Now CRM, fine. Apparently it looks good. Take a look at the weekly chart. It just moved 4 consecutive weeks here. And then it has resistance here. Question. You want an entry here? Fine. What is going to be a stop loss? Yeah, 209. Is it this stop loss level, this level, or this level? And what happened when previously it crossed this level? It rolled over. So what are the chances that it will roll over? They are high chances. Why? The reason being there will be many investor and trader who actually they were stuck at this level or this level and they are just waiting it to come down, come up so that they can get out and get their money back. Okay? So you need to be careful on that. Okay. Now there's too many questions about the stocks. For example, one is about SKHY goes down in September. Will it be a good candidate? SKHY, I think, is going to be a good candidate for long term when it comes to the support. But SKHY is fairly new. Its supports are unknown. It's relatively new in the US market, yes, but it depends a lot upon Companies like SK Hynix itself. Yeah, I'm sorry. I thought of you asking about ETF. SK Hynix. You asked asking about that company. It so the company itself is a leader in the memory storage devices, and I think it will become a long-term stock if you find a good support for that. I analyze CRM. Someone asked me, Ali Khan asked me about CBRS. What is CBRS? CBRS? Maybe I missed that. Cerebral system? Okay. Which group it is? What is it? CBRS. It is it's a new IPO, it looks like, starting from May. All right. Okay, I got it. It's a new IPO. All right. IPOs are number one, IPOs are different. IPOs are tricky that they form big moves. Let's see what is this IPOs. This is CBRS. If it is in my CBRS, should be in my system. What is ATR? Its ATR is already is down 49% from its top, and its ATR is 12.27%. That makes it a risky stock. It means that on any average day, any given day, the stock's average movement is 12% of this price. And what is the price? 196. So in any given day, it moves $12 on average. That makes a very risky stock, especially during this time frame, which is itself is a risky time frame. And it is coming down. It has lost key moving average. It's not forming a base. So in other words, this is not the right time to go into this kind of a risky stock. Okay. I just saw the stocks, checking on the stocks in light of Nvidia. Stock is not going anywhere. If it is, even if it receives a pop, it will be temporary because the headwinds are too strong for the time being for next 2 months. Nvidia probably it will have a blowout earning. I understand that Nvidia is increasing its earning. Nvidia is increasing its revenue. Then why Nvidia is not being able to move out of this no man's zone, right? It had done nothing for last how many years? 1 year at least. It was around 210 in November. So last 10 years, it is still here. Now, is long-term stock? Yes. Every time when it comes down, it finds support and it's inching up. It's waiting and waiting and waiting. It will break out. But this is not the right time for the breakout. Even if it break out, chances are there the breakout will fail and it will come down again. And that will give you a better entry at the supports. Okay? Credo again, as Aisha Sreen, Credo is a tech stock as far as I remember. And tech stocks are not in favor at this time. I have repeatedly said that you need to be very, very careful. CRDO, sorry. You need to be very, very careful. This is all a choppy thing, and most likely Credo will fail here. Because the market is not supporting, tech sector is not supporting. Credo will not go out and give you something like this at its own. It can, nothing is impossible, but chances of failing it at a higher prices are higher, especially in this scenario when it's a tech stock. So it needs to be, you need to be very convincing story for a tech stock to be in during these times. Okay, stocks is not a good holding now. It depends upon your time frame. Are you a long-term holder? Maybe months, years, no problem. Stock is not going anywhere. Semiconductors are not going anywhere. But are you a short-term trader? Are you short looking at this 1 week, 1 month, 2 month, 3 month return? Then stock is not a good holding for the time being. Okay. I hope I've answered all these queries. I'm just trying to tell you guys that according to my analysis, at this point of time, these areas are looking better, even for next two. Find good stocks which are starting their bullish trend in these areas. And just be patient. Next 1 to 2 months, the situation will improve, semiconductors will be back, and then hopefully we can find them at good prices when the trends are just starting. We want to be on this side of the trend, not on this side of the trend. This is where people lose their shirt. They lose their money because they don't understand the market's overall perspective. Market just giving back its whatever it's earned, a portion of it, so that it can absorb those gains. Okay? LGND is a strong sell in TI indicator. Strong sell on the daily time frame. But LGND is in pharma. LGND is not a tech stock, and LGND is at a sport. So that might be the change the different scenario. The indicator is showing this thing. On the weekly side, it is still not bad, looking bad. So I'm looking at maybe a kind of a more because our position in LGND. Okay, he's asking about a question about it. LGND, is this a new? Where is LGND? I also mentioned this is still accumulating. Wall Street is still accumulating. However, reduced position size is recommended amid the given market conditions. Okay, fine. Because it is clinging to the support at 50-day EMA. We are saying that, okay, fine. Sometimes we have to take risk. It is here. And that's why it is showing this. But this TR indicator on this side, it can very easily change if we like, just like it changed here last time when it came to the 50-day side. Remember? Say the 19th of May, it came to this position and then what I'm saying is that it is giving you a high reward to risk trade. Does not mean that it cannot come down. Definitely it can come down, but it's part of not a tech area, it's part of the pharma sector. And the pharma sector is doing very well. So that's probably would help it out to reverse the trend. That's the point. Okay. Now, the software itself, it goes by algorithm. What I am picking up here, those are my own. I'm not do not follow a machine algorithm. I follow my own analysis, which sometimes goes beyond the algorithm because based on my own, and that's why I always prefer the human touch and the human, I say, evaluation is much better than any given software. The software is like a machine. It has an algorithm. It will evaluate the parameter, give it the weight to each of these, and then calculate, and then will tell you this hold or buy or this. But what we are looking at a much broader picture, overall picture, just I explained, which I unfortunately I don't think that software can or any AI can easily replace. Okay. Samad, I think we had a discussion about the Bitcoin. Bitcoin definitely is in a storm. BTC, Bitcoin, crypto, there we go. And strong has resumed its trend, resumed its key averages. And the nature of the Bitcoin is that when on the weekly signal, this is its weekly time frame, you're right. When it has this kind of signal, even the first stage of TI, normally it gives a lasting move. Now, Bitcoin, I think you should go back several years. This, check out this signal. This probably was not very successful, but even then, this was Bitcoin. It never broke this level. You made this move, you made this move, you made this move, you made this move, you made some ground, and this move. Now, Bitcoins fundamentally, because of some regulatory issues or something in anticipation, the Congress will pass that bill, and it has been depressed for a while. I think Bitcoin has a good chances to at least go to this level, which is around 90,000. All right, guys, we are at the top of the hour. I would like to conclude this presentation. It was just a market overall outlook and discussion. If you like our software, seasonality, TR indicator, and if you're not a member, you can either just opt for the very basic weekly commentary stock picks, and that will entitle you to become a member of our customer group as well, WhatsApp group. And if you like to complete software, just $25 per month or $275 a year. But this TR indicator for the trading view, the complete package is $395 per year. I have a special deal going on for a month, which is ending very soon, August 31st, which is a $60 discount. And you have to just, if you scan this QR code and put this TV special at the breakout, the promotion code, will get a discount of $60. And that will reduce the price from 395 to 335. This will give you access to the complete thing, including the software as well as our TR indicator for TradingView. Any questions? Let me open up this thing. Now, I have also introduced our WhatsApp channel. WhatsApp channel is basically is just anyone can join it. You don't need to have a scan this QR code. You don't need to have a be a customer, and then you can be part of the channel. And the channel will be basically announcement and sometimes tips, some charts. I also offer free personalized coaching sessions for all my new customers as well as the existing customers. Prospects are also welcome if there are some slots available. And personalized coaching sessions last for 1 hour or maybe more than that, 90, sometimes 90 minutes, sometimes 75 minutes, and based on the availability. And that's I have received a very good feedback from people. And those coaching sessions are basically a walkthrough of our software. At this point, I think I will open up the allow participants to unmute themselves. If you have any leftover question, then we can call it a day. Any more questions, sir? Or ladies, whoever? No more questions? Okay, thank you very much. Thanks for being here. Appreciate your spending time with us, your valuable inputs. And I hope to see you in our WhatsApp group and other social media channels as well. And happy trading. Bye bye.